Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the markets and talk about what's going on. First of all, the US dollar index has had a pretty significant move upwards. We've had four consecutive sessions where the markets were positive. And again, what typically happens is the inverse relationship where the US dollar index has had a pretty significant, 3 or 4 day pop. What usually happens is that the Dow component does pull back for around 3 to 4 consecutive sessions. Again, the main reason is that, again, stronger dollar means lower commodity price, lower stock prices, because, again, a rising dollar implies deflation. Deflation implies the fact that stocks and gold should fall down to match the appreciation in the dollar or something like that. And basically, right now we're seeing the Dow component pull back on dollar strength. Okay, now 13,1200 was the last time I mentioned a level. And basically, this is where I was starting to get a little pessimistic. I was like, there's nothing that, there's something a little wrong right here. I'm not too optimistic right at this point. We did have a somewhat of a pullback, and again, looking back, I was thinking, back in 2010 when the markets were trading at around 10,000, I was thinking, man, 14,000 is a long ways away. Maybe by 2014 we'll get to 14,000 Dow. But right now we're in 2012. We're already at 13,000 Dow, and perhaps we'll have a minor pullback, perhaps around 5 to 10% before we eventually reverse that trend and we continue higher and eventually retest 13,000, 13,200, break that area, and eventually reach 14,000. And again, when we reach 14,000, it's most likely going to be anywhere between 2012, late 2012, early 2013. Markets like to appreciate, but they like to appreciate in a slow, slower increments. And a pullback is due anytime. But again, the next leg up in the rally after a pullback would most likely be 14,000 Dow component. Moving on, I want to talk about the natural gas market. Natural gas is at a pretty decent decline on the day session. Not too bad, negative 1.27%. However, it did have a negative impact on both console energy. The natural gas companies are getting hit pretty hard. Coal companies are also getting hit pretty hard, and also not the utility companies necessarily, but the alternative energy sector is also going to get hit pretty hard. Main reason is because a lot of people are going to be using natural gas generators to create energy, and the further or the more the price of natural gas falls, the more competitive it becomes against coal, against solar panels, against wind turbines, and basically falling natural gas is going to be bad to the industry as a whole. And the only way these natural gas companies can really compete and actually generate enough revenue for them to meet next quarter expectations is to find more natural gas, more shale natural gas, find more places to drill, and they keep on drilling and drilling and drilling and drilling. The main reason why it happens is because if they don't continue to drill, as the price continues to fall and their revenue doesn't improve, what's going to happen is that they're going to miss expectations even more than they ever should. But that also is a double-edged sword, because everybody is out trying to drill as much natural gas as possible so that they can meet expectations. The only problem with that is everybody is so, I guess people are just going crazy over the shale natural gas, and these companies have to drill it. Regardless, if they don't drill it, they're already automatically going to assume that someone else is going to drill for shale natural gas, or they're going to use fracking or whatever it is that they're going to do to extract natural gas, but everybody is going to do it. And unfortunately, because everybody else is going to do it, they have to do it too. And that's the reason why shale natural gas has become a commodity that has dropped the value of both coal. I don't have a chart of coal on my Market Club chart, but there's, the price of coal is falling, the price of natural gas is falling, and when prices of natural gas falls, everything else has to fall, because all other forms of energy production or energy consumption has to become more competitive to that falling price. Therefore, coal has seen price declines, which has hurt Peabody Energy. Consol Energy, who primarily produces a lot of natural gas with some coal, also is getting hit pretty hard because of the falling natural gas prices, and every other firm that does drill natural gas is also getting hurt pretty badly as well. And as for the solar companies and the wind turbine companies like First Solar, those companies are getting hurt pretty hard, mainly because of the fact that these solar panels are now becoming less economical against natural gas, because natural gas is going to be used in the utilities, and the utility companies are more than pleased to use natural gas over wind or coal or solar power because natural gas has become so darn cheap. And this is the issue with the whole entire energy industry itself. And nobody's going to do anything to stop the production of natural gas because they're all out competing for a limited amount of resources, which they're not really. Those resources aren't very limited. I mean, but again, people are competing for an abundance of, I guess, an abundant source of resources, and that's what's causing the price to have a significant decline. Moving on, silver market has had a pretty decent decline as well. We're seeing the markets pull back, and the main reason is because the dollar index is having a nice little rally for the past five consecutive sessions, or 4 or 5, whatever you want to call it. And basically, the silver market is also pulling back consistently. It is below that 200-day moving average, and it has continued to fall ever since. Typically, when a market does fall below that 200-day moving average, it usually takes anywhere from 5 to 6 months for the markets to eventually trade right above that 200-day moving average. It takes a while because you have to wait for the moving average, the 200-day moving average, to at least trend lower, and then you have to wait for the markets to have a nice little float up, like what happened between the February and March of 2012. Before it barely got above that 200-day moving average before it fell yet again. So again, this is a longer-term downtrend in play. This is a 200-day moving average on the daily chart. I am pessimistic on silver. And again, I read a report by U.S. funds, and basically the U.S. Mint did not produce as many silver or gold coins as they were going to expect in the month of February, I believe. What happened is that we saw an 80% drop in the demand for silver and gold coins over January of 2012, and that basically means that the number of people who are buying spot gold and silver in the real market, as in the physical silver and gold, that demand has dropped. The main reason why it dropped is because the price action you've seen for the past 2 consecutive years, people have been fooled on the silver rally, and then it went bust. It rallied up again and more, and then it went bust again. This is how confidence is destroyed, guys. Because what happens is that each time you get hopeful again, the markets disappoint you, and it's like a girlfriend, I guess you could call it, or a woman you date. And I guess it doesn't work out. It doesn't work out. You're dating, you ride the roller coaster a little bit higher, and then eventually it crashes even lower. And eventually, you guys just have to break up. And that's what's happening in the marketplace. People are breaking up with silver. They just can't hold on to that engagement ring, can they? Okay, moving on. The volatility index is having a nice little bounce on the day's session. Again, the main reason is the Dow component did pull back by around 50 points. To me, though, the negative 65 points again. Volatility index is having a hard time finding any form of rally. Again, I don't know why the volatility index is pulling back, even though the Dow component pulled back for 3 consecutive sessions. Again, the VXX is it's a pretty hard ETF to trade because sometimes it doesn't make any sense. Sometimes it goes up when it shouldn't go up, and sometimes it falls down when it should be going higher. But overall, volatility index does have a lot of time decay behind it. No matter what, if you're trading those leveraged ETFs, they all go in the same direction. They always go lower because of the time decay factor. And to me, when I look at the volatility index, if an event, say the Dow component fell by around 5–10%, what's going to happen on the volatility index ETF is that it's going to probably go up by give or take 30%, maybe even 40–50%. Maybe it would retrace up to that 200-day moving average. But then after a while, when the market eventually reverses, this whole market continues to go lower again, and we got to be aware that leveraged ETFs are always in a perpetual downwards momentum or downwards motion. They're always in a perpetual downtrend. It doesn't matter if it's a leveraged ETF bullish. It doesn't matter if it's a leveraged ETF bearish. They both work the same exact way. They are in a perpetual downtrend. That being said, when I look at the volatility index, do I see a short-term rally in play? Yes, it could happen. I'd assume it would happen because markets are a little overextended. We reached 13,200. We're pulling back a little bit. I didn't see enough momentum for us to retest 14,000 in the course of a couple more weeks. That didn't sound very plausible. So again, I think personally, volatility index is going to have a pretty decent rally in the next coming weeks, but it's going to be very temporary. So keep that in mind. Moving on, ProShares Ultra Short Dow 30. This ETF has had a pretty decent run so far, and again, I anticipate this to continue. Again, because the Dow Jones Industrial Average did have a pretty decent decline for the past 2–3 sessions. It lost around 150 points. This market seems to be much more, I guess, it's moving in the direction of the broader indices a little better than the volatility index, and therefore the ultra short seems like it will have a pretty decent a decent rally, and I could eventually see it going back up to maybe around 16, maybe $16. But again, leveraged ETFs always are in perpetual downtrend motion. A small bounce is only going to be very temporary, as market factors only push it in a certain direction for a small duration of time before it continues to go lower again. It doesn't matter what leveraged ETF it is; it always works out that way. And again, 1310, 1314, perhaps 1415 would be your next resistance area. Again, maybe 1450. Again, just keep in mind that there's going to be levels after levels after levels, and you just have to look at the previous areas of resistance where the markets pull back. The first area I could think of would probably be around 1360. So again, each level is going to be hit on the day session. It's going to pull back a little bit, and then it'll probably continue going higher. Once the Dow component reverses this downwards trend, chances are the ProTrader Ultra Short will fall down and it will have a significant decline. So we'll wait and see for that to happen. Moving on, the FAZ Direxion Daily Financial Bear has also, has had a pretty decent day on the session. Again, bank stocks are a little overextended. Yes, there's a lot of margin of safety on a vast majority of those banking companies. But again, you have a 30%, 40% rally. Chances are markets want to take a break. They want to start taking their profits. Once they do, bank stock starts to pull back, and that's going to make the Direxion Daily Financial Bear go a little higher. But again, these leverage ETFs are always in perpetual downwards momentum. Therefore, if you have a small rally in the stock, chances are you buy it, you sell it, you hold on to it for maybe 3 or 4 weeks before you await the next downwards decline. So again, same story here as well. Moving on, the Direxion Daily Small Cap Bear is also doing pretty good on the session. Again, I can see it having a pretty decent rally, perhaps all the way up to around the $30 area, maybe even a little higher than that. But again, small upwards move before eventually it continues its downwards momentum. So that's my review of the leveraged ETFs, and I hope you guys have a great trading session. See you later.